Little bit of a late start. Many of you that have been watching some of these live streams know that I've been back to back, and this is actually my fourth live stream. I have one more coming up later today with Larry McDonald. I'm excited for this conversation with Matt Markiewicz of TradrETFs, not only because I think what they're doing is unique as far as their suite of leverage funds, but also because they're a client of mine. So this is a sponsored conversation from TradrETFs. If any of you want to ask any questions as we're live here for the roughly 30-minute time window, doesn't matter if you're watching on X, YouTube, LinkedIn. I can see your posts. Let's make this interactive. This is going to be a really, I think, intriguing way to think about how do you trade levered funds and why certain levered funds, not all levered funds are created equal. I think it's sort of the real takeaway here. So this will be an edited podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, Spotify. Please help me keep that momentum going. Again, this is a sponsored conversation from TradrETFs, TradrETFs.com. So with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Joining me for roughly 30 minutes is Matt Markiewicz. Matt, I've got to know you a little bit over the last, 3 weeks or so here, but introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? And what are you doing currently?
Yeah. Hey, thanks for having me on, Mike. Appreciate it. Finally, kind of been reading your stuff for years, and it's really nice to be, doing something for real with you right now, which is great. So, yeah, really nice to meet everybody. Matt Markiewicz is my name. 27 years on Wall Street. Currently, I am the head of product and capital markets at a brand of ETFs called Trader. We launched this brand in May of this year, so the name may be unfamiliar to some of you. However, we have had 4 tickers in the marketplace for several years, including SARK, TARK, TSLQ, and NVDS, which is our short NVIDIA ETF. I have been in the ETF world since early 2009. I joined BlackRock, or actually at that point it was iShares before BlackRock had bought the ETF firm. All of Barclays Global Investors actually in December of 2009. So was there kind of when we were a little independent before we got swallowed up by the world's largest asset manager, but had a great 6.5, almost 7 years there as part of the capital markets team, doing a lot of work with RIAs, advisors, hedge funds, as well as most of the sell side that kind of has Delta One desks that are using ETFs as a way to express certain investment views. We launched 150 ETFs when I was at iShares. That's a pretty sizable number, and I've gotten a lot of experience kind of launching ETFs, understanding how to build products. And I went off on my own after I left BlackRock, started a ETF issuer more on the thematic side. We launched 3 thematic ETFs, and that got me in the world of learning how to do things, I don't want to say by myself, but with smaller teams, and being more resourceful to kind of market the ETFs and get the name out there. And so as I said, I've been part of Trader since we launched the brand in May, and before that, as Axis Investments, that's AXS Investments, is the parent company for the Trader brand. I've been there for almost 3 years. So yeah, Mike, that's a little bit about me.
So I got to ask you, you mentioned 150 different ETFs launched at iShares. How much of this industry is pure survivorship bias? Just launch as many products as possible. Hopefully one of them or a few of them stick, and then close the rest.
Well, it just really depends on what kind of side of the coin you're on, right? Because a lot of the smaller issuers, like we are now, let's call it upstart issuers, you can't really take that approach. You have to be a little more targeted and have I'd say a more educated guess as to what's going to work, because as the world's largest asset manager, BlackRock can kind of put anything out there, see if it sticks. And if they spend couple $1 million to launch and market a fund and it doesn't really work out, then hey, that's okay. Most ETF issuers don't really have that leeway to kind of do that from a financial perspective. So it would be great to kind of just throw the spaghetti against the wall and see what sticks. But the reality is, when you're running a business, that's not quite possible. So the bigger issuers, sure, it might happen, but in general, the other 80 issuers in the ETF space. Just, you can't do that.
I want to expand on this more because I think it's an interesting direction to go. The reality is Vanguard, BlackRock, they have a lock on like the vast majority of assets, right? Which means if you're going to be an issuer, you've got to do something really different, right? To stand out, to play in a part of the sandbox they will not come in and interfere with. Leverage funds are kind of unique in that, from that perspective. I can't ever imagine Vanguard doing a levered fund or BlackRock doing a levered fund, certainly in the way that you have done at TradrETFs. Let's talk about the appeal of leveraged funds broadly. First of all, how did it even come to pass that we have these levered products the way we do now?
Well, leverage funds in the United States have been around since 2006. And so we're talking over 18 years. The product category has been in existence. It's seen fits and starts, ups and downs. I think we're in a little bit of a renaissance right now for leverage ETFs as people understand, one of the only true ways to beat a benchmark is just by owning that benchmark or owning more of it in a more capital efficient manner, right? Everyone thinks leverage is, I shouldn't say everybody, but there's this idea that leverage in ETFs is a bit of a dirty word, right? But at the end of the day, leverage is used throughout all facets of people's personal lives. I mean, if anyone owns a house, most likely they had a mortgage. That's leverage. So you're using what little money you do have to buy an asset of a greater value, with for money that you don't have. But the problem is with a house, it's an illiquid asset. Obviously, it provides, a roof over your head, shelter, all that, satisfies basic human needs. But at the end of the day, you're not 100%, using it as an investment, right? You're using it to kind of, provide a home for your family, let's say. So in investing, using leverage is pretty common, and especially with professional investors. And as I said, it's just a way to use capital more efficiently. So it's something that, from a structural standpoint, when you're building a product, not every ETF issuer can do it, or not many of them, because you have to actually have a registered investment advisor. You're facing off against counterparties, many of which are larger banks that are providing you the credit for the total return swaps that that are underpinning most of the products. And those financial institutions want to make sure that there's not only a legit entity, but there's an entity behind that knows what they're doing. That's why there really aren't many ETF issuers, again, as I said, that are using swaps, because it does take a while to kind of set up that whole arrangement with the counterparties.
So I did want to expand on the swaps point, but before we get too granular on that, we know that markets have an upward bias. So a lot of people might think, well, if markets have an upward bias, why not just own any of these levered funds for the long run? And you and I both know the reason why that doesn't work. But I want you to explain, why owning a levered equity proxy in the long term can actually be really, really bad.
Yeah. As I mentioned, this industry is the leveraged ETF and inverse ETF industry has been around for 18 years. All 200 plus products outside of the ones, the 12 that we just launched, they're built the same way. They're constructed in the same manner, in that they give you an amplified or leveraged return on a reference asset for a particular period of time. It's important. Now, that particular period of time for those 200 ETFs is 1 day. So the 2 times levered S&P 500 ETF with the ticker SSO, $5 billion fund, that resets its leverage back to 2 every single day. So if you hold that product over a longer period of time for any more than a day, you are not necessarily going to get 2 times exposure on the S&P 500. And over the longer term, there are several, let's call forces at work, mainly due to compounding, that will make it so that you don't necessarily get that 2 times leverage. You may get more, or you may get less. And that's the problem that we are, attempting to solve and believe we have solved for it in our, the 12 ETFs that we've just launched.
And the real issue there, you said compounding, but the real issue there is it's the path behavior daily, right? When you're 2x and doing a reset. So the problem is, and I've done studies on this, is that when you're in a very volatile environment where the market goes up big, then down big, then up big, then down big, you're actually leveraging at the wrong time. You're 2x into the following day at the higher base before another big drop, and then you're 2x at the lower base when actually you should probably be a bit more to get back to break even because you've lost capital from the leverage on the prior day. So a lot of this really does have to do with just daily sequencing behavior, which is purely a function of volatility.
That's it. And sort of what you mentioned, that pattern, essentially you're locking in your losses, right, on several consecutive down days so that you're not maintaining that leverage ratio. You're actually going to be, getting less if you hold it over the long term when you're locking it in with that daily reset over the course of a couple of days. So there in certain market environments, the dailies are expected to outperform what we call a calendar reset ETF. And that would be in an uptrending market. So when you see, there can be volatility, of course, Mike, but at the end of the day, when you see something like, let's take NVIDIA, that's a great example, that is just up for 4 days, down for 1, up for 5 days, down for 2 in a row. That type of trending market, the daily reset product is expected to outperform a calendar reset product. I don't want to say that's an anomaly, right? But that certainly you can kind of see those results play out. In a sideways market or in a downtrending market, we would expect the calendar reset ETFs to actually give you that leverage that you were looking for and do so with less volatility. I think that's another thing here that a lot of people forget is the volatility in the dailies when you're holding it for a longer term has been higher than a longer reset period.
So I think this is where a lot of people get tripped up, right? Now, a lot of people will say, okay, that's fine. They recognize that and they want these products because they're short-term traders. You and I have talked about this before, but from what you've seen, it doesn't seem like those that claim to be short-term traders are really short-term traders. They're actually owning a lot of the daily reset products for longer than they might otherwise consider to be prudent.
Yeah. And I think that really gets down to, in my mind, there are two reasons for that. The first is when you leverage an ETF or a stock in your own account using the brokerage platform's leverage, it's expensive, right? It's also, it's kind of a pain, right? To be, if you get a margin call, you got to sell. Well, what do I sell? Right? There's a lot more portfolio management that needs to go on in that instance. So if you can use leverage in your accounts, right? And this is more maybe from a retail, perspective, right? You can use leverage, but it's not cheap, and you have to worry about doing that rebalancing yourself. So that's the first reason. The second reason is when these products, the daily reset products, came onto the scene 18 years ago, it was the first time anything like this has been introduced. So you don't want to do the rebalancing yourself. It's cheaper to do, the leverage with an ETF than it is versus just kind of, let's say, in 2006, buying SPY yourself and levering it up 2 times. Just easier to buy the product. The problem is it only that performance resets every day. And a lot of investors, retail in particular, they didn't understand that they're not getting that leverage over a longer period of time. However, when the markets are trending and everyone's making money, you're happy and you just continue to use the product, even though you are fully aware it's not a perfect solution, right? It's a mousetrap. It's just not the best mousetrap. The mousetrap is better than getting leverage in your account, but for, let's say, swing trading or owning it for a month or two because you believe that earnings season is really going to provide a spark into year end, and there's a seasonality trade, right? November, December, good months for U.S. stocks. You don't want to use a daily product if you're going to be owning U.S. equities, owning that product over a longer period of time. Again, because of that volatility, drag that we're seeing here.
So your answer to this as a firm is let's not do daily, because the moment one of those volatility spikes, a lot of these levered funds that are daily will get smashed and stay smashed for a while, right? It's like I was looking at some of these like 3x levered FANG type funds that are out there, and they're barely above the 2021 highs. Why? Because their daily reset into 2022, horrendous decline, kept on compounding and leveraging, to your point, creating almost like a permanent loss. And despite having this huge move since 2023, they're barely above the prior higher watermark. So talk to me about the calendar reset. First of all, how did the idea even come up among the team, and talk about the different time frames and how people should think about them?
Yeah. So we do run 4 daily reset ETFs, as I mentioned on the onset, right? A short Tesla ETF, a short NVIDIA ETF, and then we have 2 leverage ETFs that are a riff on the ARKK ETF. So 2 times long ARKK and 2 times short ARKK. And those are all with daily resets. And from managing these products for a couple of years, we would get feedback from investors. Hey, I bought your Tesla ETF at so-and-so date. It was 3 months ago. Tesla is actually down 5% over that period. Your Tesla ETF should be down 10%, but it's actually, it's down 30%. What's going on here? It's not working correctly. And, there are a couple things to play here. The first thing is, especially if you're an advisor, you shouldn't be using these products for your clients. There's obviously a daily reset. And if your client has a longer term investment horizon, there's a complete mismatch there. So there's a huge suitability issue from that perspective. And the second thing is, again, you shouldn't be using these daily products just for any longer than, a couple days at most, right? So, from that perspective, we get this feedback from individuals and from financial advisors, and it really kind of hit home that, wow, these folks are not using the product correctly. What if we could build a product that would enable them to have some confidence that over the course of a certain time period, let's call it a month, they could feel very confident that they would get 2 times the return of the underlying asset or some multiple of the underlying asset. And you wouldn't have to worry about that volatility from day to day, right? That really impacts that compounding, how it impacts the return. And at the end of the day, like if SPY is down 3% for the month of October, our SPY M ETF will be down 6%, right? So it's not like everything always goes up, of course. And that when, you're entering into, the products, but at the end of the day, we really saw a need from, especially the advisor community, tactical traders, that they did not understand that they were using these products, the daily resets, over a longer time. They really didn't. Why is my return stream different from what I expected? So you'll hear me say a lot, these products match outcome with expectation, so that, like I said, SPY is up 3% in the quarter. You're going to be up 6% if you own our SPY-Q ETF and you hold it. This is important now. If you held it from the day that the product resets, let's just take the fourth quarter, for instance, you held it from, at the close on September 30th, when the product got its performance reset, to the last trading day of the fourth quarter. That's how you measure that performance. That's the 2 times, right? So you can look at the NAV and kind of figure that out. And remember, the leverage, the effective leverage will float throughout the month. So if the SPY is down for the quarter, your effective leverage will be higher. So you'll be getting more leverage on that product because we're not resetting it every day. So we've had a lot of good discussions, especially with swing traders who are looking for dips in the market, Mike, to start to kind of come into these products. I don't know if the last couple of days here we've seen some weakness, nothing crazy, right? No, there's no panic in the market, but we've gotten a lot of indication that that they're going to start looking heavily at using, our products to take advantage of the dips versus the dailies again, because with the dailies, you're essentially locking in those losses for a period of a couple of days. And that's going to put you, in a tougher spot kind of when the market rebounds.
So this is my own naivete, but think about the math of this. Let's say conceivably somehow the market is down 50% in a month. Then the leverage would be towards the end of the month, basically 3x, right? If it's 2x, then half of that, you're adding 1.5 times, right? Is that the idea that that's the floating multiplier?
Yeah, around there. Yeah, just putting the math aside, the multiplier does float, but you will be more levered, right? If you bought it right before the end of the month, say, and you were, the reference asset was down, 40% or something like that.
Right. Right. And the idea there, from what I'm hearing, is that in the very long term, that should result in a better capture of the long-term upward drift because you're not deleveraging at the wrong time. Actually, quite the opposite. You're actually leveraging into the decline further because of that float going up.
Correct. So, yeah, I mean, that's just the natural float of, how the fund is managed, right? And we will be putting on, I don't know whether it's next week or, next, few days imminently, we will have the effective leverage. If you could bring up a fund page, that would be, good. We are going to stick the effective leverage in the fund facts so that investors know if they bought it that, that day, it's not going to be real time. It's going to be an end of day calculation. Yeah. See, like next to the median bid ask spread there, right next to the AUM, there'll be an effective leverage number right there. So, oh, wow. I'm actually, if I bought it right here, I'd get over 2 times leverage if I held it to the end of the month. So I think that's going to be useful too. We've had a bunch of requests from investors to add that. So that's in the works.
You mentioned swaps before. A lot of people may not be familiar with what swaps are. They think about leverage. They think about a margin account, literally borrowing dollars. Explain the mechanics of how the leverage is achieved.
So a swap is simply a contract between two parties, whereby one party, in this case, we'll call it a bank, where we have signed agreements, contractual agreement. They are contractually obligated to deliver a certain performance. So let's take our SPY M ETF, for instance. Our counterparties there know that on the last day of the month, they need to deliver, in terms of, cash to the fund, 2 times the performance that happened over the course of that month. So they do the hedging on everything on their side. This is not a listed contract, right? These are OTC total return swaps, they're called. And it's an arrangement. It's an agreement for one party to deliver performance of an asset to another party. And this was, obviously during the financial crisis, a huge problem because you had leverage in the financial system and, with investment banks. And if the banks went under, then, or, when they did, there was definitely talk of, well, how are those obligations going to be met? Right? If you're a fund and you're 5 times levered on a position and you're at investment bank ABC that is looking to go under, well, how are you going to be made whole, right, on that investment? Because they are contractually obligated. So that's why you have multiple counterparties to diversify that risk. right? So you don't have all your eggs in one basket per se with just one counterparty. So that's really all a swap is. It's an agreement to deliver performance, a contractual agreement. And you do it, Mike, in a very capital efficient way, because what we're doing is we're posting a margin, and then the rest of the money earns interest, right? So there's a financing aspect to it. We're paying to financing the trade, but we have all this cash in the account that's sitting there at this point, making fairly attractive, return, short-term return, money market return on the cash that's kind of sitting in there. So, a lot of people will, look at the expense ratio and say, oh, that's 1%. Wow, that's high for a management fee. 1.3%. It's like, okay, well, you can think that way, but go try and do it in your Fidelity account at 6%. And try to rebalance it. So we're bringing an institutional quality solution to the retail audience, right? Because they can't do that themselves. And especially internationally, there are a lot of international investors in our funds that aren't allowed to use leverage. So any leverage and inverse ticker, it's an easy solution for them because they don't even have the option to use margin accounts in their home country. And that's another thing I think that we're blessed here with our financial system and kind of the options available and all the flexibility and crazy products we have. And that doesn't exist in most of the countries around the world, right? So there is a large appeal for these leverage products in particular to foreign investors.
You mentioned being a newer issuer, and I'm still blown away that so many people confuse volume and asset size with liquidity. So explain why the size of a fund, and in particular your ETFs, really doesn't matter when it comes to getting in and out.
Yeah. So there's I guess a term that we use a lot in the ETF industry. It's just called the hidden liquidity, right? And an ETF's liquidity on screen at the end of the day is really backstopped by how liquid that underlying portfolio is, right? Because the ETF is just a wrapper. The ETF is just a collection of assets. It's a portfolio that happens to be exchange traded, and it's transparent. It's tax efficient. And you look at that ticker and you say, wow, it only trades 10,000 shares a day. Our SOX M ETF, for instance, right? That's our 2X monthly SOX ETF. That's for semiconductor exposure. And you look at it and say, oh, this thing is traded 10,000 shares a day. It's less than 2 million of assets. I can't buy this. Even though when you look at the spread and they're reasonable, and you think, well, how is something that is so small and just really doesn't trade much? How are the spreads fairly tight? I don't quite get that. And at the end of the day, again, the liquidity of the ETF is underpinned by what it holds. And since we're holding a swap on the SOX ETF, that's the iShares Semiconductor ETF, SOXX, $15 billion fund or whatever it is that trades like water. That's where the liquidity comes for our SOX M ETF. And the same is for SPY M, NVDW. That's our 1.75 times weekly NVIDIA ETF. A lot of successful single stock ETFs out there, but none of them give you weekly exposure. So we have weekly exposure to Tesla and weekly exposure to NVIDIA. And we're the only ones who offer that. So what you really have to look at when you're looking at the true liquidity of an ETF is what does it hold? And since really our ETFs are just backstopped by cash, that's all it is. There's very little cost for that underlying market maker or liquidity provider. When they're providing that liquidity, they're not going out and buying shares of SPY or shares of NVIDIA. When they have to create new shares, Mike, they're actually delivering cash to the fund, and we're the ones who put it to work. So an ETF is much more liquid. Any ETF, this goes, forget not just the trader ETFs. ETFs are more liquid than meets the eye. And it's always a good time to remind people to always use a limit order when you're trading 99% of the ETFs out there. Put a limit in at the ask. There's plenty of hidden liquidity out there, and many liquidity providers that when they see your order, they're going to rush to fill it because that's a fair price. And you have all these market makers that are keeping each other honest, so to speak, so that there's not much ability to arb, at one price or the other in ETFs. It's because you have a lot of market maker eyes looking at it, especially for, products like ours, our most recent ones that, again, their underliers are based on the movement of SPY and Qs, talking the most liquid securities in the world, right? They're easy to price and they're super easy to trade. So that liquidity will, let's call it, carry over to the ETF itself. And if you look at a few of our ETFs, MQQQ, that's our 2X monthly Qs ETF. We've had some very large trades, hundreds of thousands of, shares trade at one clip, one print at the offer, multiple times the average daily volume with no impact to the spread. And that gets back to that hidden liquidity aspect of ETFs.
Matt, we're going to do more of these conversations, getting different traders in as well, in terms of how they think about levered funds. But for those that want to learn more about the funds and maybe interact more with you, where would you point them to?
Point them to our website. That's TradrETFs, TradrETFs.com. We have a submission form on there to contact us. And we big team ready to kind of help you with whatever you need.
Everybody, learn more about the funds at TradrETFs.com. Again, this is a sponsored conversation. TradrETFs is a client of mine. I do believe in what they're doing. I think it's unique from a lot of perspectives. And hopefully those that are watching this will consider that if you're going to do a levered fund, by the way, you don't have to necessarily do it with equities. You can also do it with treasuries, which is going to be an interesting play, I think, for whatever it's worth in the months ahead. And TradrETFs has an ETF for that in trying to track effectively the long duration treasury side. All right. Thank you, Matt. I appreciate it. Thank you, everybody, for watching. I'll see you on the next episode.
Thanks, Mike.